Okay, hello everybody and welcome. It's a pleasure again to be with you on FXStreet.com team. Hello Adinda and hi Annie, nice to see you. I believe the sound is okay, right? Everything's fine, right? So let's start with today's webinar. The fact is that we have been preparing this with FX Street, okay, about the we begin our corner with the idea of improving the technical trading of people that start, and not only starters, right? Because market is full of things that we need to take care of. The idea is not only of talk about what book says, but also about some small tips and tricks we can find along the way, right? Anyway, we have been talking about technical indicators, and today we are going to talk about some indicators that are, of course, trend indicators. That's the title of the session. Anyway, we are going to start, and I will put a chart for the recording with the momentum indicator. I believe this is one of the classics. I love it very much. I believe it's very useful when you learn how to use it and how to read it. So we are going to take a look at it in a pound-dollar 4-hour chart, because I believe this indicator is mostly useful not only for intraday trading, but in general for almost any time frame and also almost any pair. However, keep in mind that it's always pound-dollar is always one of the most trustful pairs when applying technical analysis, right? It's the one that gives more accurate signals, usually, of course. Not everything's the law in the Forex market, but that's what I choose the pound-dollar, because when I started trading, it was the first thing I learned to do along with this pair. I have tested it with all other processes, of course, and the results were not as good as with this one. Anyway, momentum is equal C, right? Less CN. That means that momentum is the last available price, in this case 1672, right? And CN is the previous quotation in X number of periods used as reference. As the reference, we are using 14, right? So that 10 can be almost any number that will depend on the time frame applied, or the currency, or the pair in the study. But the standard, okay, the standard level is 14. It's the one that comes by default. I usually use a smaller momentum for shorter time frames, right? Where you can use a 10, okay, for, I don't know, maybe 1 hour or smaller time frames, while I usually change it to 21 when I'm taking a look at daily charts, okay? Not much more than the 10 and the 21 as extremes for the change. I found out that the 14 with very little adjustment is enough for almost any time frame, right? Anyway, as you can see, this is an oscillator, right? We call it oscillator because it fluctuates around the 100 line, okay? And the idea is that it measures the amount a currency price has changed over a certain time period, okay? In this case, 14 periods, 14 candles, right? I believe this indicator is particularly significant because we can use it to measure also the speed in price changes, right? And take advantage of that. We will talk about this all over the session. We said that generally, right, a healthy price trend tends to exhibit strong momentum, while weakening trends often have decreasing momentum, indicating a possible trend reversal, or at least a temporary correction, or some consolidation at certain levels, right? We need to learn when a corrective movement is a correction, when an exhaustion of an indicator may lead to a change in the trend, right? And of course, for that we need filters. We cannot determine any such things in the market with just one indicator. However, I believe that momentum tends to be one of the most reliable for this kind of thing. Anyway, a bullish signal usually is generated when a bullish signal is generated when the momentum rises above the 100 line, right? And on the contrary, like in this case, or in this case in here, right? And on the contrary, we said that we have a bearish signal when the momentum crosses upside down the same line, the same 100 level. That's why it's 100 sub-significant. Anyway, those are basics. We are going to talk a bit more about how to trade the momentum indicator also, okay? Some experts, some traders think the momentum can be also used as leading indicator. The fact is that I don't believe in leading indicators, right? There's no way an indicator can tell us what's going to happen in the market with 100% certainty, right? This is a game of odds. This is a game of possibilities when we have to trust in the past history to see how we can forecast the future based on mathematical probabilities of occurrence of a fact, right? And studying, of course, the past facts. Anyway, as I was saying, I don't believe any indicator can lead the way. There are some developed called so leading indicators, yet the fact is that they are as reliable as any of these ones, common one. In this method that talks about momentum being a leading indicator, the method assumes that market tops are typically identified by a rapid price increase, right? When everyone expects price to go higher, we see a strong acceleration, and that market bottom typically ends with rapid price declines, meaning when everybody wants to get out. So as the market peaks, the momentum indicator will climb sharply and then fall off, right? Giving us some divergences from the continued outward or sideways movement of the price. Those divergences are sort of understood as an advanced signal for trading. It also let us study the speed of movement, right, related to the end numbers of previous session. As in many cases, although price continues its trend, momentum gives us signs of caution of that trend and starts to turn in the opposite direction in advance of price movement. Honestly, I'm not so sure about considering divergences with momentum indicator. Despite I take them into account, the fact is that, the indicator by itself is unable to tell us when the divergence will come into play, right? We have seen several examples about that, and we may take a look if you want in a few moments at the Australian dollar, American dollar chart that has been given daily divergences with the momentum indicator since the price was around 1.0400, right? The price rise what? 1.1010, sorry. And even though there was no such thing as a bearish corrective movement, and despite those divergences. So I believe that divergences are a particular case that should be understood very, very tightly to be able to apply them. Anyway, back to the momentum. As you see, the momentum is graphically represented, right, with that blue line that oscillates around the 100 level, and it's plotted usually in a small chart below our main chart, right? So, as I was saying, the basic system for trading momentum is understanding that when the momentum catches the 100 line upside down, we have a selling signal, and on the other hand, we have buying one when the momentum catches the line to the upside, right, coming from the downside. However, I understand that there are some things that we need to read about this chart, and I guess you're going to see them even better than now that we are going to explain it, right? It's not the same understanding buying signals, right? Like in this particular case, like understanding this last cat after momentum bounces in the hamster line, retreats to the downside and extends up higher, right? That signal would not be as strong as one like this one. Why? Because we have to set an exclusion area around the momentum. I usually set not so far, maybe 0.20, right? 0.30 in the 4-hour chart, meaning 99.70, 1.30. That should be what I call my exclusion line. If the momentum comes, okay, to giving me a buying or a selling signal from any levels in between that exclusion area, then I should ignore that signal, right? Why? Because the market has not much strength. It has been hovering around its mid-level, like in this case or in this small case in here, right? So if price is hovering, or indicator, is hovering around its 100 level, what is that the market telling me at that moment? That there is no strength, because momentum is measuring strength, right? So it's telling me that there is no strength either to the downside or either to the upside, right? So it's not the same taking into account the signal that comes from like this one, a selling signal that comes from like this one from here above, right, and this one that comes from below, right, they're taking a signal that comes from very close from the indicator, right? The possibilities of failing in these particular cases are quite high, okay? Also, keep in mind that we call what we call golden crosses, right? As more vertical the indicator is, like in this particular case, more strength is showing me in the dominant trend, so the signal should be even more reliable, right? And on contrary, in cases when the cat is has a lot of slope and interesting inclination, like in this particular case, right? The indicator has been coming down and down, but honestly, we have not seen a straight movement to downside, right? I think that although could be giving me some pips, will not be as strong as a vertical one either side of the 100 level, right? Anyway, as I told you, I don't believe that trading with just one indicator is enough. To confirm signals, right, we can use very good results in the chart analysis of this indicator itself, adding trend lines to the indicator. That's maybe one of the filters we can add, right? For example, not just divergence, or meaning trend lines, okay? If we have, for example, okay, and I have been following this earlier today, right, an extended trend line indicator, right, with 1, 2 points. If we have a bearish signal, and at the same time, we have the indicator breaking below a trend line in this case, this ascendant one or descendant one, that should be a firmer signal that the price will probably extend its drive, right? That is one of the best, the easiest symbols we can apply to the indicator, right? Even though there are cases when you will find the trend line even above the 100 level, okay? And that first cat of the trend line would be my advanced signal that something is about to happen and that the prayer would probably accelerate, in this particular case, lower, right? On the contrary, well, I'm just that because the trend, dominant trend in here is bearish, right? We can go back, and try to find a bullish case, right? And see if we have a break to the upside, like here, okay? We have a break not only of the 100 line with a pretty vertical movement, but also of the trend line. In fact, if you take a look, the indicator also completes a pullback to the indicator before the trend line, before resuming its bullish trend, right? I know it's not as easy as it seems. So I believe the best way to trade this momentum indicator is filtering as Alexander Elder proposed, right? The developer of the indicator, right? With a simple moving average. I believe this is one of the best trading strategies of the classical ones that has been developed till today. Give me a second. We will choose a color. Okay, that one. Okay, that is just a 20 simple moving average. I have been testing this, and I will tell you that it's almost it's one of the most reliable strategies in almost any possible time frame above 1 hour in almost any particular cross you choose to trade. Okay, of course the behavior of the indicator will be different regardless to the wide intraday range the pair has or not, but it's one of the most reliable strategies we have. The moving average, as I said, was the 20 simple one, right? And to confirm my signal, right? To confirm my selling signal, in this case that we have been watching of a very bearish slope in the indicator, right? I just need to wait for the indicator to break the 100 line and also next candle, right? Open below the moving average. If I'm going to the upside, like in this particular case, I will have to wait for an candle opening above the 20 simple moving average, right? If I'm bullish, cat plus the candle opening above the moving average. If I'm bearish, the cat plus the candle opening below the moving average, right? Where do you place your stop in these cases? Of course, the stop will be related to the time frame we are using, right? If I'm trading the 1 hour chart, I won't be using a 100 pip stop, right? Maybe a 20, 30 pip stop. and I will try to place myself at the other side of the moving average, the contrary side of the moving average, right, in an average of 20, 30 pips if I'm in the 1 hour chart, 40, 50 pips if I'm working in the 4 hour chart. Why? Because the usual, the average of pips this signal tends to give, right, is around 80 pips in 4 hour chart. As you may know, when we have a trading signal, it takes 4 candles usually to develop that signal, right? So after 4 candles, usually the pound gives an average of 80 pips. What do we have, for example, in here, right? We have a movement to the upside, a pretty small 4 hour candle opening above the moving average, which leads to further gains, right? And barely, 40 pips, half the way, half my 80, okay, to the upside before the price starts falling back. When the indicator starts doing this and the moving average is flat, I ignore that signal, right? Because we are seeing a consolidating stage and we are not seeing something more, a clear trend developing, right? As I was saying, the exclusion zone will not only will depend on the distance from where the signal is coming around the 100 level, but also in the flatness of the 20 simple moving average. If the moving average is flat, then no trading opportunity should be taken. Back to what I was saying, the 80 pips average, if not more, and on contrary, in this particular case, I barely have 40. Why? Because the dominant trend in the pair is bearish. I always said the same. You can trade against the trend, but you can't ask the market to give you the same exact reward that if you trade following that trend, okay? So what I tend to do when I trade, I'm following momentum, as I always said, I tend to watch one bigger time frame, right? That's the one that I'm going to trade. Meaning, if I'm watching this 4 hour chart, I will be probably trading the 1 hour chart, right? So if the dominant trend in the 4 hour chart is bearish and I'm going to trade a 1 hour chart, I will be looking for selling opportunities, right? Meaning I could take buying one, but my profit will be much more shorter. I will not be watching for the same amount of pips. I will be watching for half the pips. Average, any trading strategy you apply will offer you the same results. It's always the same. When you go against the trend, you have less profit. So, and usually I tend to use more tight stops. Why? Because if the market reverses and resumes its dominant trend, right, the probabilities of being losing much more than I'm willing to, right, increases. So that's why I prefer a tighter stop. Okay? When it comes to this indicator, also, what I would like to add is that not only the positive indicator, this strategy mostly with combining momentum and the 20% average, is that there are 2 other things that you must take into account. If you have an important buying or selling signal, like these 2 particular cases when we have a pretty vertical cut, let's do it again, and here, okay? There we are. Okay, we have a strong buying signal in there because of the verticality of the indicator, while we have a strong selling one around this area, right? Because of the verticality of the indicator also. You will notice that as the trade develops, right, the 20 simple moving average also goes with the price until it finally gets stops there, right? In this case, the downside until it finally gets stops there. If you want to apply a trailing stop, you can, as long as you keep it below the 20 simple moving average. Why? Because when the pair catches or approaches to the moving average, it's telling me that the movement is getting exhausted, right? As you may see, when we have a good signal, it usually ends when it retests the moving average. That is that's one of the conditions I get to get into the market, right? If I have 2 conditions, that is the indicator heading higher and the candle opening above the 20 simple moving average, when I lose one of that condition, that is price coming back below the 20 simple moving average, I should exit my trade, right? And that goes not only when you are profiting, right, but when you are losing also, okay? If you take a signal because you think it's a good one, yes, price reverses, and we see a candle opening above the 20 simple moving average, well, that's the time to say, okay, I was wrong, or the trade was wrong, or the market was wrong, or the indicator was wrong. I will take my position out of the market. Why? Because there's a good chance that you're going to lose a lot more, right? The probability says that you have 80% of losing in that particular moment. So why waiting for your stop? Close the trade, right? You will be in that way limiting a lot your losses when trading with this particular strategy, okay? And the other thing I want to add before talking a bit about another technical indicator is the fact that you can also draw levels in almost any technical indicator. That's something you should take a look at when you're trading. Of course, those levels will depend on the time frame, right? It will change in different time frames. For example, let's put a line in the 101.60 area, right? Around there in the momentum indicator. I will turn the indicator charts a bit smaller, right? And I could set that maybe it's a bit too low, right? But it was the latest high. Maybe I should put it a bit higher, around here, okay? And check that level as a resistance area. I need to check to the background, right? Not just the latest spring. And see how many times the price has reached that area and starts a retreat, right? Or if that too low, maybe I need an extra level. Maybe I need to push it a bit higher. Yeah, maybe, right? That's the idea. Set a level where you can draw a support of a resistance inside the indicator, right? Not in the chart, but in the indicator, right? Those levels will be a guide as you know that when the price action reaches that area, that particular area, there's a good chance that the trend will stop and reverse. However, if I change this chart to 1 hour chart, right, the levels will be probably different, right? We are not going to see price reaching such strings with smaller time frames, right? 108. I move it to the 4 hour chart. I have reached 102.40, right? So keep that in mind. Drawing levels of support, of resistance, of extreme exposure of the indicator is always a useful way to determine up to where the price can go and where I could see the price reversing, right? If you take a look at the bottom, we have several stops around the 96 level in this particular chart of the pound, right? And every time the trend reaches that area, we see an important price reversal, right? In the bigger time frames, no doubt. It's the bottom level, right? So take that into account. In this particular case, price raised at almost 400 bps, okay? In this particular case, the price rise 601, okay? So keep that in mind when you trade with an indicator. It's not necessary, maybe it's not something, those levels, something that you will use daily basis. But it's worth to take a look at your past charts, at your previous history, and try to terminate those levels, okay? And once you have them, mark them and leave them there, okay? And maybe in the middle of your trading session, you will find out one day the price approaches to that area and will be a great warning of telling you when the price may start reversing, okay? Of course, you don't need to draw one. You can draw 1 or 2 resistance levels. However, I would recommend to do not more than 2, okay? Just don't start drawing one here, and one higher. That seems too odd, right? Look for the streams. Look for the streams of the indicator, particularly over the last couple of years. Why? Because the market evolves and market changes, right? So the behavior over the last couple of years is most likely to continue occurring right now than the behavior of the market 5 years or more above before those 2, okay? That's the general idea when you draw resistance areas in your technical indicator. As an example, and we are going to talk about it next Friday, right? The ADX indicator, right, barely reaches 60. It's something that it has been proved, right? When the indicator reaches the 60 level, it starts to fall, right? With the momentum, we have not a certain area that applies to every pair, okay? But do your own study And keep in mind what I always say before starting the webinar, and today I forgot. These are UK time zone charts, right? Maybe if you're using another time zone chart, your channels will be different, and the reactions of the market will also be different from mine. So do your own back testing before running into a trade just because of a strategy you have seen in any kind of webinar, okay? Anyway, we will continue with relative strength index. So another indicator I choose to share with you today, not too much what we are going to talk, so it will fit the time we have available, okay? Anyway, today I want to complete the session talking a bit about the relative strength index, right? And in this particular case, I choose the euro-dollar for our charts, or the euro-dollar growth, mostly because, as I was said, pound is a currency that tends to saturate, right, with relative strength index, meaning you reach the 80 reading showing you overbought condition, you reach 20 reading showing you oversold conditions, yet price continues rising, right? So I don't find it reliable for pounds. Also, I don't find out relative strength index quite reliable for German exchange crosses. On the contrary, I found that it's mostly reliable for euro, commodity currencies, and sometimes, of course, the rest of the European Union. However, let's start by saying that the relative strength index attempts to continuously measure the strength, right, of offer and demand. We said that that 50 level in the middle, right, is where offer and demand are equal. So the price should be in a consolidated stage, as we have no much of a price variation. And of course, that never happens in the Forex market, right? So if we are above 50, the above 50 level, the market is bullish, while if the indicator is below that 50 area, we assume that the market is bearish, right? It's a pretty traditional chart, right? And as you can see, and we have set the levels, I have set the levels in 80 and 20. By default, the levels that come with this indicator are set at 70 and 30, right? But I found out that 80 and 20 seem a bit more reliable with latest year's market volatility, okay? As I was saying, in the middle, we are in a neutral situation, right? No bullish, no bearish, no demand, no offer, bullish above the indicator, bearish below. However, if we are above the 50 level and reach the 80 area, right, that will suggest that the pair has reached an extreme, right, that the trend may start exhausting, right? We have reached overbought conditions. At least that's what the technical indicator says. And on the contrary, if the price falls and we reach 20, we said that we have reached extreme oversold conditions, and there's a good chance the trend may reverse to the upside, right? However, may reverse or have reached any of these extremely oversold conditions, that's not actually signal a reversal, right? We have seen cases daily basis lately. I was following the dollar Swiss franc, if you want, chart, and you will see that the indicator is in constant, right, oversold territory, right? And that's enough just to trigger short-term corrective movements to the upside, and it barely affects the dominant trend, right? Technically, right, we said that when we reach the extremes of the indicator, either the 80 or the 20, both the demand or the offered strength, right, is excessive, right, and close to an end. But close to an end, ready to change direction, it doesn't mean it will happen. We need to filter any kind of trading using relative strength index with another kind of indicator, okay? That's why I like to combine the two, the relative strength index and the momentum indicator. Because if I see both in extremes and momentum starting reversing to downside, right, then yeah, I could assume that the trend is exhausted to that certain way of market and will probably reverse. But on the contrary, if both indicators are not going along, then I will tend to ignore any kind of oversold or revolt condition. Mostly what I use relative strength index for is for the fact that maybe if we turn to smaller time frame, you will see what's going on, right? I would say we cannot spend 24 hours a day in the market, right? We have to sleep and live sometimes, eat, sometimes stay outside a computer. I know that when we start trading, that seems really complicated to do, but we need to, right? So let's say that all of this never happens, right? That we are at this particular time of the market. We wake up, we see the chart, and we see a strongly bearish euro, right? Around this area, right? A strongly bearish euro, okay? And we are ready to trade. Are we going to sell? Well, the fact is that if I have daily signals anywhere around these levels, below 30, in between the 30 and 20, or even below 20, right? I will tend to ignore that selling signal coming from any kind of indicator, right? I use it as a filter, right? Also to control the emotions you have when you take the first glance of the market. Well, the first thing I watch in the market is the trend. The second thing I want is the oversold overbought condition of the currency. You don't need a technical indicator to do so. You may like to also just measure the intraday range developed till the moment you start trading. Meaning, I usually wake up a couple of hours after Europe is open, right? So by the time I start trading, all the Asian session has already occurred, and also the European opening. Well, what I tend to do is say, okay, this pair, how many bits does it move? If it's stuck in the euro or the pound, and it has moved 100, 140 bits already, in the range that usually moves all day long, right? I would be careful with trading following that trend because there's a good chance to see a reversal. Or I will wait to a corrective movement against that trend to try to follow that trend back, right? There's no need to rush into the market. So first I take a look at the trend, then I take a look at the relative strength index or whatever indicator I'm using to measure the sustained conditions of the price at the level I'm getting my trading signal, okay? The important thing here is that both the 20 and the 80 level are just fixed levels that give us a guide, right? We have to take a second step to find the best entry point. We cannot wait to or decide to buy when the market reaches 20 or sell when the market reaches 80, right? We have also to take the chart and the study. Usually, I filter also with historical support and resistance levels, meaning daily lows, weekly lows, monthly lows, right? If we reach, not in the 1 hour chart, but in the 4 hour chart, we reach, I don't know, extreme oversold conditions according to relative strength index. And price is quite close to a historical level, right? And fixed support or resistance area, then maybe I will dare to go against that dominant trade, placing myself on the other side of the support and resistance, right? But we need to filter. I don't believe that trading solely with relative strength index will be a profitable strategy. Honestly, I would prefer to use this indicator as a filter rather than a signal, okay? However, it may support your signals, okay? It may support your signals because despite they have different names, different formulas inside, all the technical indicators are just averages of historical data, okay? So they show all more or less the same behavior. If we have, give me a second, right? The indicator hovering around its midline, exactly as we discussed in momentum, right? It's telling me that the market is showing no clear direction, right? As long as we hover in around the 50 level, I would say 55 and 45, right? That's the exclusion area for relative strength index. Whatever signal to the downside I get or to the upside I get when the indicator fluctuates or comes from that exclusion zone, right, should not be considered valid because the price is, the indicator is showing me that the offer and the demand are quite equal and there's no much more of a definition. At least I cannot be clear about market direction coming from this indicator. Maybe I can use another one, right? But that's the general idea. Of course, according to the book, the indicator is able to generate buying and selling signals, right? Usually we say that the relative strength index shows us higher buying and selling probabilities, but it's take notice of the trend change indicator. I'd rather watch the trend change indicator rather than seeing peaks or bottoms. Another thing that is pretty interesting, before I forget, sorry, about the peaks and the bottoms we saw in the indicator, right? Let's go to smaller time frames and maybe we can find a clearer example, right? Usually, the reversal signals are more reliable indicator, either if we are below the 20 level and when the price re-enters the 20 or above the 80 and the price re-enters the 80, right? That's the signal of exhaustion, sorry. Or when we have a B shape in the indicator, right? When we have a B shape in the indicator, rather inverted or positive, it's telling me that there is a short-term spike, right? A peak in the price action. Those B, right, when we saw the indicator opening a new candle, starting a straight movement down, right, and forming a B, well, that's a signal that there's a top in place, short-term, long-term, whatever you want to watch it, right? Let's go back to daily charts, right? We have a peak and a B in a B shape, like in this particular one, right? Advancing me further gains in the cross. Okay? Also, as we discussed for momentum, you can use in relative strength index as support and resistance area or pullback zones, right? If we are above the 50 area, right? As long as we are above 50, I would say that the bullish trend will dominate the market, right? Okay. If I have a bounce or a retracement towards the 50 level, and like in this particular price, the price bounces back higher, right? Okay, it's telling me that the trend was correcting and will probably continue. Okay, on the contrary, if the price cuts the 50 level in a quite vertical way, like in this particular case, there's a good chance to see a stronger slide in price action. Okay? Keep in mind, when talking about any kind of technical indicator, and I have changed to the hourly chart, right, that some indicator, or in this particular case, this indicator is applied to the close, right? You see, you know that you can apply your indicators to the close, opening, high, low, etc., 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 right? So, if I apply it to the close, right, this stream in the indicator, okay, is showing me right now, right, information related to past candles close. It's not taking into account what is going on with current candle. Believe it or not, and despite we have no much of a technical difference in price, right, if you apply the indicator to the open, right, it tends to change. Let's see it in the 4-hour chart, okay? In here, okay, 4-hour chart, this is open. Give me a second. I will change it back to the close, okay? Okay. See the difference? If I apply it to the close, right, I have this rising spike because it's taking into account current close price action, and price is going higher, it's taking into account current close price. But if I left it, right, if I leave it, not left it, to the opening, right, it will be giving me the information of this candle opening and not taking into account what happens ever since. Okay? So, despite there's different advantages of using the opening and close, the fact is that in this particular case that we are talking about the opening, when we have signals using momentum or relative strength index, using the opening price, the indicator applied to the opening price, we will have very, very few signals, but meaning less signals than when applied to the close. Sorry, but those signals will be much more reliable. Okay, they tend to be much more reliable. On the contrary, all right, if we leave the indicator as it can by default, right, of level to close, right, we will probably get much more trading signals, not also clearly profitable, right, but we will have more accurate information of what's going on with current price, right? It's a matter of choices. I'm not saying that one is better than the other, okay? It's just a difference. And as we are talking about this, let's take a look at this also. The fact is that applying to the high or the low, right? I don't consider that very important. Why? Because we have spikes, intraday spikes that can trigger movements either way in the market, okay? That can disturb a bit or be a bit noisy when regards to the technical analysis, right? So I tend to ignore those spikes in the moment that they are developing, right? We don't know if current spike in current candle is going to be at the daily high or daily low, right? It's just about this candle. So I don't found that to be reliable information. Let's just set my price, okay? And the median price and typical and weighted close price, right, are just averages, right? More or less like a pivot point that tend to accomplish all the or compile all the information of previous candles. Also, I believe that that's too complicated. That's why I limited myself to either the opening and the close. Again, the close, if I apply to the close, I will have latest data available reflected in the indicator, right? While it's now going higher, if the price starts falling, let's go to, I don't know, smaller time frame, maybe we can see it later, right? Right now the price is slightly bullish. We don't have too much volume in the market right now, okay? So not much to see. But see, when the candle starts to turn negative, the indicators start also to turn negative. Right? Not that I trade 5 minutes or that I like to watch. It's just to show you an example, okay? Okay, so I will have the most accurate information about what price is doing with the indicator applies to the close. Okay, but when I apply it to the open, I will have much less signal, yet more reliable ones. And that goes not only for relative strength index, but almost for any kind of technical indicator, or at least for class one. Okay, anyway, wishing you all a great weekend, and hopefully we will be back on Sunday with the live coverage, okay, and the market opening. Okay. You're welcome, Dolly. Thanks for your words all. Thank you. I love to see a lot of ladies in this room, okay? Thank you, and bye-bye. Enjoy your weekend.